You have little to no investing know-how and little to no capital, but you still want to invest in the markets. Is this impossible? In this video, I will explain in 4 steps why this is possible. Stay tuned. My name is Hamann from H2 Intel, helping you succeed with investing. Please note that none of this is financial advice and you are responsible for your own actions. So how do you start investing with little know-how and little capital? Step number 1, earn more than you spend. Why? Because you want to increase the savings that are investable. And how can you earn more than you spend? So there are a couple of tricks that you can do. One is to track your expenses in the first place. This will give you a lot of clarity where you spend your money, like for example on housing, rent. It could be food, it could be travel, it could be subscriptions, whatever it is. If you have these broad categories and if you track your expenses, you can really figure out, okay, where do you spend your money and how much of your money are you spending. This gives you a lot of awareness and a lot of clarity. Once you have that overview over your expenses, you can then cut unnecessary expenses. This is very important because I see a lot of people, they spend a lot of money on stuff they don't really need. So figure out for yourself, do you really need those expenses? And if the answer is not or not clear, then cut it out. This will help you a lot. Another way to earn more than you spend is to increase your income. There's always a way to increase your income. You just need to figure out how you make this possible. If you have a business, you can try and think how you can charge more, a little bit more. There's always ways to increase the income. If you have a normal 9-to-5 job, you can still maybe have a side business on the side which earns you an additional income. You can ask your employer simply, I want a raise, and explain to your employer why you deserve this, but just push it a bit forward because this will at the end of the day give you more income. Step number 2, invest the savings in good assets. Now, why should you invest your savings in assets? Because if you just accumulate the cash and have it stored in the bank, your cash devalues by 2 to 5%, maybe even much higher now through inflation. And this leads to a reduction in your purchasing power. This is what you want to avoid. That's why you do not want to store your savings in cash for a long period of time. You want to buy assets. And assets historically, depending what assets you buy, historically have shown returns of maybe 10% per year compared to a decrease of cash in purchasing power. Now, what is an asset and what advantages do assets have? So, first of all, the biggest advantage of an asset is it protects your purchasing power from inflation. This is already a big win. Then, what is an asset? An asset is something that puts money in your pocket. So a positive thing. And money in your pocket could mean it is a cash flow in your pocket or it is an increase in the asset value. This is then on paper. So the cash flow that you have could be from a rental income from an apartment you own. The apartment is an asset. The rental income is the cash flow. And you see that cash flow you can every month in your bank account and you can spend it in theory. So this is really cash in the bank, spendable cash. Now, the other type of income that you can generate from an asset is through asset appreciation. This means the asset rises in value over time. And although this is not a cash flow, this is still very good because it increases the value of your assets and also your wealth, and therefore the value of your savings and therefore the value of your purchasing power. So both is good, and that is why assets are important, because they put money in your pocket. What are examples of good assets? That could be public stocks, could be private stocks, could be real estate, could be crypto assets, and there are many more assets which are good, but those assets really have shown historically good performance. And if I say stocks, always remember a stock is always a business behind that. So for example, just a very simple example is if you go to the supermarket and buy food, this is a business. And a stock is nothing else than a business that provides a tangible value in the real economy. Especially the US stock market is a very well established market. It has shown great returns over time, and high quality always will protect your downside. And if we talk about real estate, for example, multi-family real estate, just think of it as an apartment. And remember, location is important in real estate. You always want to choose a high quality location, could be in bigger city centers, for example, because this will protect your downside. The quality that you buy will protect the downside. And it is okay to have a loan from a bank in real estate. In other assets, I would not recommend it, but in real estate, it's okay. And you have to have maybe 20 to 30% of own capital to buy the asset, the apartment or whatever. And you lend, for example, 70% from the bank. That is a ratio that is healthy. But you do not want to lend too much from the bank, because otherwise your risk increases too much. And always remember, protect your downside, and buying high quality real estate will protect your downside as well. Now, if you're starting out and have little amount of capital, real estate is a bit too complex, because it takes quite a little bit of capital and also some know-how to get into that. Also, real estate is not very liquid, so the ease of selling the asset is not very good. Private stocks is a little bit different. You can get into private stocks with limited amount of capital, but it is highly illiquid like real estate. So in private stocks, you will not be seeing your money for 5 or 7 years. And for a beginner, in my opinion, that's a bit tough. And I would, at the beginning, start with something very simple. And examples of assets that you can buy with limited amount of capital and know-how are, for example, public stocks and also crypto assets. A way to get exposure is, for example, in the public stock sector to buy US stock index ETFs, and in the crypto asset sector you can buy a split, 50-50 split of Bitcoin and Ethereum. So 2 high quality crypto assets in the sector. And the idea is to buy those assets continuously over time, over and over again. Now, why the US stock index ETF? Because it's very easy to get in. You can buy those at pretty much any broker, and it takes little capital to get in and also little know-how. Also, the US stock market index ETF has shown great historical performance. And also your downside is protected, because you do not take individual company risks. So if a company goes bankrupt, it will not affect you as an index holder. And also the US stock market is very well established and carries less risk compared to an emerging market, for example. And why crypto assets in a 50-50 split between Bitcoin and Ethereum? Because it's very easy to get in, and it takes little amount of capital to get in, and also little amount of know-how, because these are just the 2 most high quality assets that you can possibly buy. And the likelihood of them going to zero is really low. Furthermore, I believe the historical returns are good, and I think the space will grow the next 5 to 10 years. This means you are still getting in quite early and can expect decent returns in the future. Step number 3, optimize your taxes. And optimize means reduce the taxes, of course. Now, why is that important? Because there's differences in the taxation of employment income, which is taxed quite highly percentage-wise, compared to business or investment income, which are taxed much lower. That is why it's always good to make investments, because they are taxed lower, but it's also good to maybe have a side business on the side, because there you can also reduce taxes. But there are also ways to reduce your taxes as an employee, and my suggestion is get a tax advisor to reduce those costs, which can be quite high, or figure it out yourself. There are always creative ways to reduce the tax burden, and this will pay off massively, so do not underestimate this lever you have in your hand with this, and it can increase your investable capital and your savings and your purchasing power overall. Step number 4 is wait and repeat. And this means you stick to your plan, you buy to hold, and you have a long time frame and a lot of patience. Very important. And you will only be able to wait and have this patience if you build a little bit of know-how, because you need to know or trust that your approach, that your plan is, and the assets that you're buying, that those are solid. Because if you do not have this confidence, then you will not stick to your plan, and after 1 year you will abolish the plan and you will go nowhere. And this understanding will really help you out a lot in having this patience and in sticking to this plan. And you can learn about stocks and crypto assets, a lot of theory on YouTube, for example. There's a lot of free stuff available, so just learn, get educated, and this is the way to go, because at the end of the day you must know what you own, otherwise you will not stick with it. And in step number 4, wait and repeat. Really the idea is to buy and wait and hold the assets, because you're buying great assets, and over time those assets will become more valuable, and this just takes time. And when the assets become more valuable, also your savings will become more valuable, and your purchasing power that you have will become more valuable. And this is simply what you have to do, not just 1 month, but every 12 months of every year, and then the next year as well, and then the next year as well. So really it is about consistency and a long time frame and patience. And if you have this patience, your assets will grow so much, and your cash flow from your assets will get that high that you can use that cash flow to spend in your life, or sell a small portion of the assets to spend in your life. So it is always okay at some point to spend, but first of all, you buy to hold and you do not sell, and you use all cash flow for reinvestments. But at some point, of course, you can spend some parts of the cash flow and some parts of the assets in your life, because at the end of the day, what good are those assets and those cash if we don't use it, right? And I believe those 4 simple steps: earn more than you spend, invest the savings in great assets, like for example public stocks or crypto assets that are easy to get in, that are very liquid, and to optimize your taxes, reduce your tax burden, and wait and have patience and stick to the plan. Those 4 steps actually will have a dramatic impact on your wealth growing effectively over time. And this sounds maybe very simple and too easy, but it is not. It's just most people cannot do it, or they don't have to do the research, they don't have the know-how. And I believe with this solid, simple plan in 4 steps, you will become a millionaire over time. Of course, not in 1 or 2 years, but over time it will happen. It's not a matter of if, it's a matter of when. And you can calculate the stuff yourself, and it is quite amazing that even with a totally normal salary, you can make this happen. It's just about the discipline and having a solid, simple approach, avoiding a lot of mistakes. And this is a very good foundation where you can start already. Of course, you can boost returns, increase performance and so on if you dig much more deeper, but this takes, of course, more time, more know-how, and of course you also a little bit more capital. Remember, the best time to invest was yesterday, and the second best time to invest is today. So take some action, start investing, it will pay off massively, I believe it. And I wish you all the best. Happy investing.